All right. Matt, the mortgage guy. In today's video, I'm talking to pre-approved home buyers who are out there home shopping in 2022. I've got some information for you that's going to be helpful, things you want to avoid. You don't want your deal blowing up before it gets started. Stay tuned. All right, Matt, the mortgage guy, residential mortgage broker, happy to help you in 50 out of 50 states. If you'd like to contact me and my team, go to greatmortgagebroker.com, fill out the form, let us know where you're at and how we can help. In this video, I'm talking to pre-approved buyers. And really, I've just noticed a bunch of different things come up with pre-approved buyers that could affect you. So I want to put together a video to say, look out for this stuff, right? Because there's a lot of stuff between getting pre-approved and getting that letter and actually getting yourself into contract. So things to consider. First off, let's clarify, what is a pre-approval? A pre-approval is you submitting an application and supporting docs, having a lender review everything, verify your income, your assets, do whatever work they need to do on the back end to say, okay, based on all the information we have, you're good to buy a $600,000 home with 10% down. Granted, nothing changes, right? And that's the important thing that people forget about. Granted, nothing changes. Not only is it interest rate, but in this video, I'm going to talk about interest rate, homeowners insurance, Mello-Roos, HOA, variable pay, all the things that I'm seeing that may affect your pre-approval that you should be aware of. Okay, let's talk about the first one first. I think it's pretty obvious, right? If you get pre-approved in January of 2022 at one rate and rates go up 1-2%, right? The biggest increase we've seen in a long time. You need to be in touch with whatever loan advisor you're working with to see how that affects your pre-approval. We've got a lot of folks pre-approved. Some of them are touch and base every 2 to 4 weeks. Some of them we haven't talked to for a couple months. They've put their plans on hold or they're just not out there looking very aggressively. When it does come time and you're actually planning on going to look at homes, planning to put in offers, make sure you know based on today's interest rate exactly what you qualify for. Because just because 6 months ago or 3 months ago or even a month ago, you were approved at a certain amount, it was based on that rate on that day and all the information that was collected on that day, right? Okay, so that's the rate one. Know that a lot of good loan originators are going to factor in a little bit of a buffer. So it might not be that, you go from 600 down to 540. It might be like, okay, you can go to probably about 570 based on this latest rate change, right? But it's all subject to when you got pre-approved and where rates are today. Another one that comes up that I think is less common for folks to think about. We pre-approve you. Let's say that rates haven't changed, but you start looking in a rural area that's got a higher homeowners insurance premium. That's going to affect what you qualify for because you qualified based on this purchase price. We know what the taxes are going to be. We're going to estimate what the homeowners insurance is going to be. And maybe you've got mortgage insurance on your loan. That total payment versus your income is calculated into your debt to income ratio. If the homeowner's insurance needed for the house you're buying, because maybe you look at a more rural area, is triple, you're going to qualify for less house. And so let me put it another way. Let's say your total payment is $3,000 at, your 500 purchase price with whatever down payment you're putting down. If we thought the homeowner's insurance was $80 a month, but it's $300. Now you've got an extra $220 a month. You don't qualify. Maybe you can only qualify for $440 in a place where the homeowner's insurance is that much more expensive. And for anybody who's in California, rural areas, you might have to have a couple different plans in place. You might have to have a California Fair Plan on top of the regular homeowner's insurance. So I've seen this exact scenario happen. I've seen it play out. Be aware of it. Another thing that's going to affect your payment in the same way and affect how much you qualify for is if the specific neighborhood has Mello-Roos. Mello-Roos tax generally in newer neighborhoods where there's newer builds. They're putting in schools, they're putting in churches, they're putting in other things, and they're taxing the new homeowners. It's going into your tax bill, meaning if we estimated 1.25, which is pretty common for most areas that we're doing in California, but this specific area has Mello-Roos tax that brings it up to 1.4 or 1.45. That's going to affect how much you qualify for. Be aware, be on the lookout for that. Another one is homeowners association dues. It's not just on condos. Sometimes it's on a single family or some sort of planned unit development, a PUD they call it. But again, anything that affects your monthly payment, any additional cost is going to affect how much you qualify for. If you qualified for $600, know that if you go look at condos that have a $350 a month homeowners association due, you got to recalibrate that pre-approval. It might be that, okay, if there's a $350 HOA, you only qualify for a $500,000 condo. If you went and bought a $600,000 house with no HOA, you're fine, right? It's all how it factors in to your debt to income ratio. I've worked with a bunch of different clients that started out looking at houses. Now they're looking at condos. It's fine. We just have to adjust the price, right? And it's not a perfect science because some condos have a $350 HOA, some $220, some $275, some $180, right? And so what we've done is try to coach clients up. Here's the payment, right? Use our little handy Excel spreadsheet. Know that the max payment you can qualify for based on debt to income is, let's call it $3,200. Type in the HOA, type in the purchase price, and then you'll see total payment. Keep that payment under a certain amount, right? So that's another one to think about, to consider, because it's going to affect how much you qualify for. Last but not least, if you've got variable pay, if you've got anything that's changed, maybe when we got, even if the lender did their job, even if the lender did what they were supposed to do with variable pay and got a verification of employment from your employer saying, here's our year to date, here's 2021, here's 2020, and we did a calculation, things might have changed in the last 4 months. And okay, there's no longer overtime at my job, so you won't see that in the last 3 paychecks. That's going to affect how we calculate variable pay, right? Where there's variability in hours, where there's overtime, where there's bonus, where there's other things in your pay that varies. We've got to take an average. And so some lenders aren't going to do this at all, which is a terrible, terrible thing, right? If you talk to a lender and they say, listen, we're going to order a verification of employment so we can get a good feel for what your pay is and what the underwriter's going to be able to use, take that as a good sign. This lender is doing the work to make sure you're dialed in. If they don't do that and you've got commission or bonus or variable pay in any way, they're really doing you a disservice because they're just guessing, right? Know that even the lenders that do this properly, like our office, right, is always going to do this. If there's any question on income, we can't do it in January and then expect that to still be good in May, right? We've got to update that probably every 2 to 3 months. Lastly, for buyers who might be asking the question, okay, I hear what you're saying. What do I do? How often do I talk to my lender? How often do I update them? I would say when you're active and you're putting in offers, check in. If you don't look at houses for a month, there's no reason to email or text a lender every day to ask what rates are because you're not actively looking. But this weekend we're going to look at these 3 houses. I love them, and I've set that up with my realtor. Ping your loan officer, ping your loan advisor, tell them, hey, listen, we're going to look at houses this weekend. Just wanted to confirm we're good up to 550. We're looking in an area, that I think the homeowner's insurance is going to be about what you estimated here. And just ask the questions, right? I think that communication up front is going to save a lot of heartache, a lot of, oh, shoot, I didn't consider that on the back end. Have it up front, contact your lender, make sure you're working, in tandem, real estate agent, lender, everybody's on the same page. It makes for a smoother transaction. It makes for less, surprises and whatnot on the back end, because last thing you want to do, go have an agent submit an offer at $600,000 with a $350 HOA. And then you come back and the lender goes, well, 1, the rate has changed, so the rate's higher. 2, $600,000 was based on a single family with no homeowners insurance. So you don't qualify, unfortunately. We got to add a co-borrower, do something else, right? Like that's not how you want to do things. Do the work up front. Again, if we can help in any way, we're more than happy to. Go to greatmortgagebroker.com, fill out the form, let us know where you're at, how we can help. We'll be in touch soon. Bye-bye. Oh, I didn't even say it. Until next time, we gonna see.